Hey there, I'm estate planning attorney Paul Rabelais, and in this video, I will address the common tax issues that relate to planning your estate and passing it along to your desired loved ones with minimal tax consequences. So this video is part of a playlist I have created that will, when I'm done, contain about 8 videos that address people's biggest estate planning objectives and how to address them. The playlist was created out of a need to get people away from thinking that estate planning is merely getting a will or creating a trust, but rather you should be thinking, I have certain concerns about my estate and my heirs. Here are what those concerns are, and let's find a solution so that I don't have to worry about that anymore. So I made a video, I'll link you to it above, that describes 7 estate planning concerns people commonly have. Now in this video, I'm going to address one of those concerns, taxes, which is commonly expressed to me as, what are the tax rules surrounding estate planning that may relate to me during the estate planning process and when I pass away? And how will my loved ones be affected by the tax laws when they inherit? So let's see if we can put you on solid footing when it comes to the most common aspects of taxes as they relate to the estate planning and the estate settlement process. So I'm going to break it down into 3 areas. First, tax aspects while you are alive that relate to estate planning. Second, tax aspects when you die that relate to estate planning. And third, tax aspects to your heirs after you pass away. First, tax aspects during your lifetime. Let's start with what are the tax consequences of establishing a revocable living trust, which is something many Americans do to allow their estate to pass to their loved ones outside of the court and attorney-involved probate process, which applies to assets in your name when you die, whether you have a will or not. Some people make a decision to avoid creating a revocable living trust because they do not want to have to go through the process of getting a tax identification number or employer identification number. We'll call it a TIN for now. They don't want to get a TIN for their new revocable living trust. But this assumption that they would have to get a TIN for their revocable living trust is incorrect. The IRS has clearly stated that settlors or grantors, people who establish revocable living trusts, settlors or grantors of revocable living trusts are not required to get a TIN or EIN for their trust. They are allowed to use their Social Security number when they establish a revocable trust account. And any income or deductions that are attributable to the trust simply get reported on the grantor's or settlor's personal income tax return. The other tax area where people sometimes get tripped up during their lifetime relates to the tax aspects of making gifts. I'm going to refer you to a video I did recently that addresses the consequences of the 2022 gifting limitations. But here's the basics. Gift tax rules say you are limited to $16,000 gifts when making gifts to others. Most people mistakenly assume that if a gift is made that exceeds $16,000 in a calendar year to someone, then somebody has to pony up some tax dollars to the IRS. But that is just not the case. Generally, if you make a gift to someone, even if the value of the gift exceeds the $16,000 present interest annual exclusion threshold, no one owes any gift tax or any income tax. However, to the extent you make a gift to someone in a calendar year that exceeds $16,000, you just start using some of your $12.06 million estate tax exemption. So most people who make gifts in excess of $16,000 to someone do not need to fret about having to pay taxes, although they may have to file a gift tax return and report that they used some of their $12.06 million estate tax exemption. Next, let's go over the tax ramifications of what happens when you pass away. As I just alluded, there is a $12.06 million estate tax exemption, but most people don't have a $12 million estate when they die, so there is no concern about the 40% federal estate tax. Regarding your income tax return, your final individual income tax return is prepared in the same manner as when you were alive. All income up to the date of death must be reported on your final income tax return, and all credits and deductions to which you are entitled may be claimed. But when you die, your assets become property of your estate. Any income those estate assets generate may trigger the requirement that your estate file an income tax return. So note the distinction here between your estate filing an estate tax return when the value of your estate exceeds, for 2022, $12.06 million. Note the distinction between that and the fact that your estate may have to file an income tax return for income that your estate generates after your death. Your personal income tax return, as you probably know, is called IRS Form 1040. Your estate's income tax return is called IRS Form 1041, U.S. Income Tax Return for Estates and Trusts. Your federal estate tax return, when you have more than $12.06 million, is called IRS Form 706. Similar rules apply if your assets are in your revocable living trust when you die. Your final income tax return will reflect trust income up until date of death. Then your living trust's return will reflect income your trust assets produced after you pass away until those assets are dispersed to your living trust beneficiaries. Next, let's address the step-up in capital gains basis that occurs when you die. When you inherit investment assets, you can reset the asset's original cost basis to the value of the asset as of the date that the person you inherited the asset from dies. So your heir pays capital gains tax only when that asset is sold after your death, and only if the asset appreciated in value after your death. The step-up is perceived as a bit of a tax loophole in the tax law in that it reduces or eliminates capital gains tax to your heirs on the post-death sale of your assets that appreciate in value prior to your death. Now let's address tax consequences that people face after one passes away. Another bit of a tax loophole is that an inheritance is not considered income for income tax purposes, whether you inherit cash, bank accounts, investments, or property. So you might be getting the idea here that under the right circumstances, leaving someone an inheritance or receiving an inheritance can be pretty much a non-taxable event. You know, I've had people tell me, Paul, I am going to get slaughtered with taxes. My father just died, left me $2 million in his bank account, left me stock that he paid $100,000 for, but it's now worth $2 million. And he left me a house that he paid $250,000 for years ago that is now worth $1 million. That's $5 million of assets. And with all the death taxes and other taxes, I'm going to get hammered by Uncle Sam. And I'm like, no, you're not. There's no estate tax because your father's estate was less than $12.06 million. There's no income tax on any of it because an inheritance is not considered taxable income. And all that appreciation from the stock and the home will go untaxed due to the step up in basis. So you just inherited $5 million tax-free. That's why an inheritance can be so valuable, because that person who inherited $5 million would have to earn $8 to $10 million in compensation or ordinary income just to net that $5 million. Now, sure, if you are the beneficiary of a traditional IRA or a 401k, your distributions from those accounts will be taxable income to you. And also, any income that your inherited assets generate after you inherit them is taxable income. For example, if you inherit stock, which gets put in your name, future dividends that the stock generate are taxable income to you. Okay, so hope this clears up some aspects of the tax consequences associated with planning your estate and settling your estate. Make sure you like, subscribe, and comment. I realize that anytime I do a video about estate planning and taxes, it generates lots of questions in the comments. I can tell you now I won't be able to get to them, but if any of you viewers would like to comment to the questions, feel free, and thank you in advance. You all have a great day.